Welcome back. Dominic, before the break, you were talking about how we haven't seen inflation like this since the 1990s. And we do have a board that we'll bring up. What sort of similarities and differences are you seeing now compared to then?
We have two things. We had a bit of helicopter money or a lot of money that went into hands because of the COVID crisis. And then you have a geopolitical situation that's causing disruption. So this inflation scenario is a little bit different because it's not only driven by, let's say, higher wages or a specific just oil shock. It's really a geopolitical situation, and it's not clear when that's going to reabsorb itself. We didn't have the situation with chips missing for cars or computer chips such as missing for cars or those type of situations. So we have to get through that to get the inflation situation under control. And I think that's why the Fed wants to raise rates, because they're trying to control the demand side. They can't really control
Yeah,
the supply side, right?
yeah.
So they're trying to say, okay, let me get the consumer to slow down. Kind of makes sense because if you look at the 90s, and I think I make this reference all the time with my family. I mean, we had, my parents had a credit card in the 1990s. I think it was still in the plastic wrapper. Nobody actually used credit for other than buying their house. Now today, you buy your televisions, you buy your car, you consume only on your credit card. So the direct impact that it has on the consumer when you raise rates right now is really impactful.
Yeah. Let's talk about the opportunities then in the fixed income space. Government bonds. What would you advise investors do if they want exposure to government bonds? Do they keep their duration short? Should they go long? 5 years?
I still think that the mid to short term duration is very interesting to have. I think if you look, I think these are like cycles, and your portfolio managers do this. Like we do this in our accounts. We're going to start considering going overweight the provincial space, for example, which is a quasi government. There's a lot of yield to go get in provincial space. So, for example, a 30-year Ontario bond, you'll get about 95 or 100 basis points of additional protection in the long end. I think we should maybe have your portfolio skew a little bit shorter in the 5 to 7 year bucket, and that becomes interesting. So these are things we're doing in our portfolios right now, where we were, I would say, in flatteners to a larger extent into the portfolio, and then now we're looking to add some government credit. And what I mean government credit, it's CMBs, anything that's I wouldn't say guaranteed as a triple A, but something that's very solid because it has the ability to taxation and has a great track record, that type of credit. And then eventually, I think as we get closer to this roll into, are we in a recession or not? When we start talking about recession or hit a recession, I think that's when corporate credit becomes really interesting. It's already widened significantly, as you know, IG has moved. If you use 5 year IG, maybe from 50 to as high as 105 down to 80. And I think now it becomes interesting to get back into that credit cycle a little later on in the fall, especially if we get a pause signal from the Fed. But we're already seeing that, the market is driving the Fed policy a little bit here with,
Yeah.
10-year rates at 265, 270. So, and we've had a strong bid on the corporate sector because I think people are seeing there's value. If the rates stabilize, there's value to be long in credit. And then I think high yield too has been pushing in for that also. So there's a bit of a market timing with that. So if you're asking for an individual, I think it's difficult for some individuals sometimes to make those calls. So in most fund managers have the ability to do that in their portfolio, where they can go overweight or underweight or add. And I think that's what people are doing right now. They've cleaned up the quality of their credit portfolio over the last couple of months. And now I think slowly but surely we're going to start increasing our credit exposure.
Dominic, we have about a minute or so to the next break. You mentioned corporate bonds. What are you seeing in this area?
Well, there's two markets. So the US market is, I would say, a little fragile these days. We've had supply recently in the marketplace, and it's not really outperformed. It's been pretty steady. In Canada, though, it's a different story. Canada's a very closed-end corporate bond market. There's not a lot of supply, especially in the long end. So it's been pretty steady, I would say, in terms of the value. And I would say the quality of the Canadian names is also, I wouldn't say higher, but I think there's better stories in Canada. So we still like corporate bonds. It's a question of timing right here, but we're going to start to probably apply a little bit more of an overweight, probably in the fall, as we get a better, clear indication, like I said, on the economic call and the Fed's actions.
And the quality of the profits are it's still okay right now
I
here in
think so.
Canada?
I think so. I mean, we're going to see some impact, obviously, on some of the earnings, but it's still very, very good. I don't see any dire warnings on that, and that's why maybe even the equity market is not in a bad place. Especially if we continue to see consolidation in the equity side. People are saying we're in a bear market, but if we go a little higher here, there might be an opportunity where the market might adjust a little bit more. So the equities look like a good space also.